Thank you. It's a great pleasure to be here. I have a career in the banking, but then in '98 I ended up in real estate and been there for 16 years now. So that's why I picked a topic where I think I can basically tell you whatever I want. So I will cover some issues, highlight some insights of my experience of the banking today, which is absolutely different than it was when I was starting my career in the early 80s. Running it until '98 in the banking industry. And then I'm coming back in the end of the presentation shortly to the real estate side. So I need to explain a bit my background and where I'm coming from, so maybe you understand a bit better my scope. I want to try to be very specific because this is a huge area where I could use whatever topics, but I want to be highlighting a few items in the financing industry and then coming back to the investments and the real estate at the end of the day. I'm coming from a Swedish listed company which is called Catella Group. It's listed in the Stockholm First North. We became listed in 2010 when we merged with another company which happened to be listed. And through that we created kind of an interesting mixture of banking, financing industry and property advisory asset management business. And after being in the advisory business for 10 years, I landed in the asset and investment management, which in our firm is called Amplion. And here I want to highlight one specific thing here in the down there. We've been managing mostly the assets what the rest of the market don't want to touch. So there are a lot of things you can do if you focus on something which is not really interesting for most of the people. So we will try to create value out of those assets. The other field of business, in 2010 I got a call from my boss from Stockholm and said that Timo, now we have a merge with the company which has a bank in Luxembourg and there is some lack of resources in Luxembourg and you happen to be a banker before and you are the only one in the group management, so could you go down there? So there I went and then I came back in 6 months' time. But then the guy we hired there left the beginning of 2013, so I've been now there close to 2 years in running a bank which is called Catella Bank in Luxembourg. Our main business is credit card operation. It's extremely interesting, global, growing, highly automated, IT intensive, and we are sitting there with 140 people running everything our own in our own shop, based in Luxembourg. So it's a quite exciting environment, but also, I have to say, very much different when I came from early 80s, early 90s business from banking. So why the banking is so difficult today? I'll try to explain it. How many, by the way, how many in the banks? 1, 2. Great. Okay. So maybe
it's so difficult.
So you, it seems to be. Well, if I remember right, the banking industry before the recession was something like 45,000 people, and it went down in 4 years' time to 20,000. So that was the impact of the recession. Which comes back to where I need to start. It seems that now what we are facing, it's called, according to Bank of Finland, it's called Great Recession. Recession seems to be something where we are stable, no growth. We had a hit of 10% close to GDP downscaling in 2008-9. Then the dot-com bubble was only a bubble. We didn't end up in real problems, and I think banking was not really suffering that much. And then the early 90s real bad situation we had in Finland was called Finnish Great Depression. That's the terminology we Bank of Finland used. And you can see also the difference that of course it had a lot of pain when 20% of the people were unemployed compared to now, which is amazing that how many people are employed versus where we basically are. But this gives a kind of a background for the banking. What happened in 2008 when Lehman Brothers went down, bankrupt, which never was thought to be happen. That was when our banks went more or less bankrupt. It didn't really cause any problems in the global economy. We were suffering on our own issues here in the early 90s in Finland. But when Lehman went down, then everything really changed. And that changed the whole industry. So this is from the Pentti Hakkarainen's presentation lately in Bank of Finland, saying that 4 reasons why the new regulations need to be in place, why we need to control, monitor, the financial industry much more than it was used to be. So we need to reduce the probability that there will be future crises and negative effects, because taxpayers basically pay always the bill, and they don't want to have it anymore. To increase the bank's solvency and liquidity, so you need to have more equity in order to run your business. Too big to fail, not becoming too big players in the market, which will then turn down also the countries supporting these banks, and to harmonize and be more efficient controlling in crisis managing the banks who end up in problems. In 15 years' time, or close to 14 years' time, 15 years' time, you can see that the balances of the banks really went up until the end of 2008, but the equity, which is the red column down there, didn't really increase. So huge risk built up with no real equity supporting them. That's why taxpayers need to be very cautious when you see these kind of pictures building up. And now while the regulators are behind the banks. And here we have the main guy in Europe, sitting now in the European Central Bank, and just lately, a few weeks ago, launched their latest news. You need to boost the economy, meaning the banks. You need to go out, you need to lend more money. You need to lend to the small SME businesses in order that they employ more people. And we need growth, because we are stable everywhere, or downscaling. Europe is getting older and more floppy versus the Asia and the US. So what at the same time, they say you need to increase the lending, go more out and lend more, we will give you the financing, but at the same time you need to increase your capacity, the equity, which is very tough for the banks. If you don't make profit, you don't get the equity, and you need to increase continuously your own funds compared to the lending you are doing. So it's really a tough call for banks as such. What happened, how clients are behaving, they don't really like lending, they're paying back the debt. Here you can see after 2008 that the dramatic downscaling the lending in the corporate sector, households also quite passive. So there is a lot to do in order to get these people back. And at the same time, this is the difference what I said when I was in the bank before and when I'm now in the bank, the regulatory environment. This is Ernst & Young 2013, a picture of different items which are governing the bank, even S-Bank being one of the main players in Finland. They need to adapt with all of these ones. We are doing the same in Luxembourg in our small operation. And it goes back to the different, how to treat your clients, what you need to inform them when you are selling the products, how much equity you need to have, how do you control your businesses, compliance is the main thing. And as you can see here, it's only said that this is a fraction of those environments. So there is tons of more coming and already in place. I take two examples. One example just to show that if you're a banker who may have some international clients, well, this first one goes back to more my business, fund management in real estate. It could be private equity management also. There's new regulation saying that everybody who has more than 100 million euros under management in Europe need to register under the AIFMD regulation, Alternative Investment Manager regulation. And this is a heavy burden. I think we just filed, we have a company of 12 people here in Finland, and we just filed tons of paper, like a stack of paper like this one, to the Finansinspektion, or well, local regulator here. And this all came because this Madoff went bust, and the Ponzi scheme really evidenced that the fund managers are not regulated, so you need to have a lot of compliance and risk management and transparency in place if you want to run this business. And that's really creating a lot of headache. And here was a study in Luxembourg in June this year, when the new regulation, and you need to file your application in July, only one of the three was ready for doing their homework. So it's not really, the market is not there yet. It's a big burden. The other thing, as an example, is if you happen to, it's called FATCA, And every bank who has any international clients, and I think even Finland and all the other European countries, they sign with the US government a treaty saying that everyone, if I have a client who has any links with US, I need to inform that this client I have to the US tax authority, and he's earning some income here in Luxembourg or Finland or whatever country. And here it says anyone with links to US. There are 7.4 million US citizens living in Europe, and only 1.3 million are filing the tax document every year. So there are close to 6 million missing. And that's where they are after for those people. But that's not enough. If you have a green card holder, you are a Finn who's been working there and got a green card in the US, you will be flagged too. So we will inform your data to US tax authorities. And then, if you just happen to be working there, like Veikko, at some point of time, I don't know if they're hunting you, it was some time ago, but if you would be doing this 10 years ago, you should file your tax report to US every year since then. And I don't know how long.
There was a special case between Finland and the US. I could still utilize that when I was there.
Mm-hmm.
So I didn't pay my taxes to the US because of this.
Yeah.
If I had stayed for 2 years or more at that time, then I would be paying full tax.
But now they want to know that if you earn the money outside the country and you are not paying that what is belonging to US. And I'm fine with that because we need the taxes to every nation. So that's why it's implemented. But you can only imagine what kind of IT system software changes you need to make sure. Being in Nordea or some other big bank, in order to be able to deliver this automatically, because you don't want to end up having manual process to sending this data. And what the bankers in Luxembourg do, they go to seminars like this one. There is a Ernst & Young seminar describing a study that how costly this all regulation will be. So where is this leading? It's leading that who is paying the bill in the end of the day. Of course, we need to control, and there is a lot of demand and good reasons behind this, but it's a really huge burden, and this is costing a lot of costs, and that's why your mortgage margins are going up, even the interest rate is low, and you will going to pay more than less in the future. Leads to consolidation, of course, the IT and all the other structure, support functions are heavy. Focus, maybe you have more niche players in the market, and it also has led to shadow banking. Shadow banking is interesting. As banks are heavily regulated, now you have a lot of debt funds. You go out as a fund manager, if you file this AIFMD regulated document, you are entitled fund manager, you go out and then you ask pension funds or whoever want to get a bit more higher income to invest your debt fund. And then you start lending money to corporate clients and the real estate investors and private equity or whatever. But they are not regulated. So there is a new industry going on and developing around the financial industry, which is heavily regulated. It's very interesting to see if we will find out that once again the financial industry is always more clever than the regulator find out the ways to which way to go. Then, to my final point, if theoretically you would have some money to invest, where would you like to place it? And it's quite an interesting environment. It goes back to the banking. Normally you select from equities, bonds, real estate, maybe gold or some other alternatives. I'm trying to give some picture of the interest rate and the bonds and the real estate as some food for thought. It's really the interest rate is all-time low. After the ECB came out. Now, if we have some more money than we need, we go back to the central bank and we place the money there. So we will be paying 20 basis points, 0.2% every penny we put there. I think I would not be surprised that if the banks need to implement at some point of time cost of having the money in the bank. So if you have 100,000 euros in the bank account, you will be charged, because that's really painful to get that liquidity now. Because there are some other issues around this which I don't have time to explain, but I cannot anymore lend to the other banks because regulator thinks that the most risky institutions and the partners in this environment is the other banks. I need to place it somewhere else, maybe General Electric or somewhere, German government. But let's look about the German government. The 10-year bond is trading what? German government trading close to zero. I think I just checked. 2-year German is 6 basis points minus. Finland is minus 2 or 3. So we as taxpayers, we should be happy. We are getting money from the market without them paying us today. The expectation, what happened when this ECB came out, the upper curve here is the future expectation for 30-year bond. So if you invest in the German 30 years, lock your money. In August you got close to 2.3%. Now you get 1.8. 1.8 keeping the money in German government bond for 30 years. That's. I used to think that inflation is minimum 2%, but I don't know really what's happening here. And expectation is that gradually the interest rates are going to go up, but it's Finnish 10-year bond today is 1.1%. Just 1.1%, 10 years, Finland lending money. This is my second last slide. I try to highlight here the dilemma. If you go to the bank and you meet your banker there and they start to provide you some opportunities where to allocate your money. I have 3 options here. You have no. How do you get the beaver? It's here. Okay. So bonds. Finland 10 years, it's 1.2. It was 5 days ago, now it's 1.1. So you earn 3,000 euros net per year. You don't have inflation hedge, it's fixed. You have a huge maturity risk. If interest rate goes up, your bond value goes down. Your income is fixed. Okay, 10 years. Then, very typical for us Finns is to have, okay, I will invest in the rental house or flat. I buy a flat from Helsinki. Let's take an example of that one. Good quality apartment, 50 square meters, 250,000 euros, average 5,000 euros per square meter, 4.5% net income, 11,200 per year. In 10 years' time, you earn 33% more than having only a bond. That's if everything goes like that. And then the market where I'm mostly working in, the real estate, that's the more fun and exciting part. It's the not secondary, but something more exotic, like K-market or hypermarket somewhere in the growth cities, with Kesko maybe having a 10-year lease. You buy it with an 8.5% yield. Your income annually is more than 20,000 euros. So in 10 years' time, your cash is 73% up. Or you could say, you can lose 73% of the value, and you are still even with this one. Okay. And why this is so complex? The interest is so low that in my world, this cannot really continue forever. It's impossible. It's impossible. Well, we've seen in Japan that happens. So it has been taken 10, 15 years, and that's really bad. So buying this real estate, this is residential fluctuation, volatility in the house prices. Of course, we had a bad up and down in the early 90s, but we just keep the property. Basically, the value is quite steady and not that volatile. So, conclusion is that, of course, real estate might make sense. And on top of that, if you have inflation, then your rent will go up in the index. So I would say that real estate, and especially this part, which most of the people don't have an access, is not that bad idea if you can manage that. And that's where we are providing the service, trying to make, for some institutions, some good risk-adjusted returns in this part of the business. Finally, the problem is that you as a retail client, if you go to the bank, this is kind of a disclaimer or warning signal saying that be careful. You quite often now are offered some indirect real estate investment products. They are called funds. Normally you had funds for equity and fixed income products, and now also the real estate products has becoming more popular. After 2008, our pension funds and all the institutions, they really learned their lesson. If they select a manager like ours or our competitors, they say, okay, Timo, we pay you in the end. You don't get anything in the beginning. You provide us a nice deal with good promises and good story, but you need to deliver and we cover your cost in the beginning. But in the end, we will then pay you if you really, we share the profit. So that's quite fair, right? So if we deliver the value, we can get share of that value. Most of the retail products are expensive. They take the money as a 2% subscription fee, even though they don't just get your money in. And then on top of that, the fees are pretty high. So I have serious doubts that these products may end up in problem during the coming next year. Some of those. Because of the fee structure and the investment profile, the yields and the costs are not matching. So be careful out there. Thank you.